Have you ever found the absolute perfect property, only to get bogged down by slow, traditional financing? Well, today we're going to demystify a really powerful financial tool that can help you grab those opportunities when they pop up, the bridging loan.
So, here's what we're going to cover. We'll start with the property puzzle they solve, then we'll look at how they bridge that financial gap. We'll get into what lenders actually care about, the true cost of all that speed, and then we'll hit the most critical part, your exit strategy. And finally, we'll wrap up by looking at why it's a specialist tool and definitely not a crutch.
All right, so let's set the scene here. Imagine you're in a high-stakes property situation where time is a luxury you just don't have.
What am I talking about? Well, maybe you've just won big at an auction, and you've got just a few days to come up with the cash. Or, that property chain you were relying on, it just snapped. Or maybe you found a real diamond in the rough that needs a ton of work before any normal bank would even consider giving you a mortgage on it. So how do you lock that deal down before the opportunity just vanishes?
Well, this is exactly where the bridging loan comes into play. It is the solution that was designed specifically for these kinds of time-sensitive financial puzzles.
So what is it, really? A bridging loan is a fast, short-term loan. We're talking anywhere from 1 to maybe 18 months. It's secured against a property, and its whole purpose is to bridge that temporary gap in your funding until your main, long-term finance is all lined up. And here's how it's totally different from a regular mortgage. Speed is the big one, right? We're talking about getting funds in days, not weeks or months. But the focus is also completely different. A mortgage lender, they're going to pour over your income, your credit score, the whole shebang. A bridging lender, honestly, they're mostly concerned with just two things. What's the property worth, and how are you going to pay them back?
And there's another really important distinction to make. If you're getting a loan for a property that you or your immediate family are actually going to live in, that's called a regulated loan. It's protected by the FCA, which means more paperwork and more checks. But if it's for an investment or a business property, one you're not living in, it's unregulated, which means a lot more flexibility and, you guessed it, even more speed.
So you might be thinking, if they're not laser-focused on my income, what do they actually look for? Well, it really just boils down to three core things, three pillars of approval.
First up, the property itself. Lenders will get it valued, and they'll usually lend you a percentage of that value, what's known as the loan-to-value, or LTV. And here's the great part. The place doesn't even need to be habitable. Second, and listen, this is the most critical piece of the whole puzzle, is your plan, your exit strategy. We're going to dive deep into that in just a moment. And third, well, there's you, the person. They'll still do the basic checks, IDs, source of funds, just to make sure everything's above board.
Now, if you're a first-time investor, lenders might look for a little extra reassurance to, de-risk the deal in their eyes. Having a strong salary definitely helps show stability. Owning other assets is a big plus. If you're planning renovations, showing them you've got an experienced builder on board, that's huge. And of course, borrowing a smaller percentage of the property's value always makes you a much safer bet.
Okay, so all this speed and flexibility sounds amazing, right? But, and this is a big gut, it comes at a cost. And it's so important to understand that this cost is way more than just the interest rate you see on an advertisement.
That headline rate they show you? It's charged monthly, not annually like a mortgage. Predictions for 2026 put it somewhere between 0.5% and 2% per month. On a big loan, that adds up incredibly fast.
But this is really where people get caught out. The interest is just one slice of the pie. You're also going to pay an arrangement fee, usually 1 or 2% of the loan amount. Then there are valuation fees, broker fees, and, get this because it's a big one, you have to pay the legal fees for your solicitor and the lender solicitor. These costs really stack up. So let's get to it. We need to talk about the single most important part of any bridging loan application. Honestly, without this, nothing else matters. I'm talking about your exit strategy. Here's the bottom line. Lenders have to know with confidence exactly how they are getting their money back. A fuzzy plan just won't cut it. Your application will be rejected, flat out. Doesn't matter how great the property is. Now, there are two main ways people plan their exit. The first one is simple. You sell the property. You buy it, maybe you fix it up, and then you sell it on, using the profit to pay back the loan. The second way, which is super popular with investors, is to refinance. You get a long-term mortgage, like a buy-to-let, to pay off the bridging loan.
But, and this is a huge heads up if you plan to refinance, you have got to be aware of the 6-month rule. A lot of mortgage lenders simply won't let you refinance a property until you've owned it for at least 6 months. What does that mean for you? It means your bridging loan has to be long enough to cover that waiting period, plus the time it takes to get the mortgage approved.
Now, of course, there are other ways out. You might be moving on to a bigger development loan, or maybe you're using cash from selling a different asset. An inheritance can work, but you have to be careful. Probate can take a really long time. And that last one, rebridging, think of that as the emergency eject button. It's taking out a new bridge to pay off the old one, and it should only ever be a very costly last resort.
All right, so let's pull all of this together. When it comes to bridging finance, what's the final verdict?
Let's just recap the key takeaways here. First, think of this as a specialist tool. You use it for speed, for opportunity, not as some kind of casual loan. Second, yeah, it's fast, but it is expensive. You have to be prepared for those high monthly rates and all the extra fees. Third, and I can't say this enough, your exit is everything. Plan it before you even apply. Fourth, remember, the lender cares about the property's value way more than your salary. And finally, please get professional advice. A good broker is worth their weight in gold here.
At the end of the day, a bridging loan can be the key that unlocks a deal you thought was impossible. It can make things happen. But the most important question you need to ask yourself, it's not, can I get the money? It's, do I have a bulletproof, rock-solid, and totally realistic plan to pay it all back?